Hard money lenders for business, hard money lender for commercial real estate. Consider hard money lenders if you are looking for a business loan. These types of lenders specialize in providing loans to businesses that are having financial difficulties. They provide short-term loans to these companies at high interest rates. When you apply for a loan from a hard money lender, you will be required to provide collateral. The collateral can be anything that has value to the lender. If you fail to pay back the loan, the lender can sell off the collateral and use the proceeds to repay themselves. Cash-strapped businesses usually turn to hard money lenders for financing. If you are thinking about starting a business or expanding your current business, you may need hard money lenders. These loans are used to fund projects such as buying equipment, remodeling, or purchasing real estate. They are also known as commercial loans because they are used for businesses. Money business loans, easy approvals, fast cash loans online. Bridge loans are short-term loans designed specifically for small businesses. This type of loan is often referred to as a bridge loan. It helps a company get through a temporary period when their finances have been disrupted due to unexpected events like illness, injury, natural disaster, etc. Bridge loans come with terms ranging anywhere between 3 months up to 1 year. When applying for a bridge loan, most banks look into how long the borrower plans on keeping the business open during its recovery time. In addition, they take note of any other debts the borrower might have outstanding. A good credit score is important if the applicant wants to receive approval for a bridge loan. A bridge loan is not considered a permanent solution, therefore, borrowers must keep paying the principal balance each month until all debt obligations are paid in full. Once the loan is repaid, the borrower's account becomes eligible again for another bridge loan. Business loan types, small business finance options and funding sources. Private money loans are similar to personal loans, but instead of being made directly to individuals, private money loans go towards funding businesses. Private money lending institutions offer financing options to both new and established businesses. Common examples include SBA loans, venture capital firms, angel investors, family members, friends, and local community groups. The process of obtaining a private money loan varies depending upon which institution offers them. Typically, applicants fill out a loan online application form online or over the phone. After submitting the completed forms, the lender reviews the information provided and determines whether or not to approve the request. Most applications are approved immediately after submission. The amount of funds offered by private money lenders depends upon several factors, including the size of the business, the industry sector, and the firm's reputation in offering the loan. Many times, private money lenders only make loans to businesses located in certain regions. Therefore, before choosing a particular provider, check to see what areas of the country they serve. Borrower requirements for collateral-backed loans. The loan process for a collateral-backed loan begins once the lender has accepted the loan application from the borrower. The first step involves verifying the financial stability of the business owner. An in-depth background investigation will be conducted by the lender on the person seeking the loan. During this phase, the lender checks public records, tax returns, employment history, and more. Next, the lender verifies the value of the assets pledged against the loan. Time in business can be a factor in determining the level of risk associated with a loan. If the business owner has operated their business for less than 5 years, they may face greater scrutiny regarding their ability to repay the loan. On the flip side, however, longer operating histories tend to indicate better repayment potential. Finally, the lender performs a valuation analysis to determine the worthiness of the collateral. If everything goes according to plan, then the lender can proceed with processing the loan. Otherwise, the lender may decide to decline the loan altogether. Collateral-based loans are ideal for commercial properties such as retail stores, restaurants, hotels, office buildings, shopping centers, warehouses, factories, and much more. By pledging these items as security, the lender ensures that they will collect payment should something happen to the asset. Lower loan fees and interest rates. Collateral-based loans tend to carry lower interest rates compared to other types of traditional loans. In addition, many banks have special programs designed specifically for small businesses. This means that if you apply through your regular banking channel, it could take longer to get the approval process going. Additional loan collateral includes inventory, accounts receivable, equipment, vehicles, real estate, other tangible goods. When applying for a private money loan, most borrowers choose to use their own resources as collateral. Although using one's own assets as collateral carries risk, some benefits are associated with doing so. Advantages over business loans. Interest rate is generally lower. No credit score required. Loan terms vary based on the company's situation. Disadvantages. Riskier due to lack of collateral. Requires additional paperwork. May be difficult to obtain when working with large amounts of debt. If you're looking for a way to finance a major project without having to rely solely on your personal finances, consider taking out a private money loan. Commercial real estate loans, what are they? Real estate investment trusts are companies whose primary purpose is investing in income-producing real estate. REITs differ greatly from conventional mutual fund managers. REITs purchase pieces of real estate while mutual funds buy shares of stocks. A typical REIT owns hundreds or thousands of rental units across multiple states. REITs use their holdings to generate revenue through rents paid to tenants. Investors receive dividends based on how well the company does financially. Real estate crowdfunding refers to the practice of raising equity investments via internet platforms like Kickstarter and Indiegogo. Crowdfunding sites allow entrepreneurs to raise money from people interested in supporting their projects. Commercial bridge loans are similar to construction loans, but instead of financing new building construction, they finance existing structures. Commercial bridge loans provide working capital for owners who wish to renovate or repair older facilities. Competitive rates for potential investors. Bridge loans often come with shorter terms and competitive interest rates than standard renovation loans. Because of the high risk involved, most borrowers must already own the property being renovated. Bridge loan projects can include anything from minor renovations to complete overhauls. The borrower may plan to sell the property once the work has been completed. Or, the owner might intend to rent the space after completing the upgrades. Either way, the goal is to improve the value of the property. Lenders take ownership of the property if borrowers default on their loan. A commercial mortgage broker helps buyers find mortgages for commercial properties. CMBs negotiate deals between sellers and potential buyers. A bridge loan lender provides funding to help pay off debts owed to another financial institution. The borrower then uses the proceeds to repay the original creditor. Second lien creditors can foreclose on a property if the borrower does not make payments. The difference between a commercial mortgage broker and a commercial lending agent is simple. Mortgage brokers work directly with home builders and developers. Agents represent only specific lenders. Brokers may offer advice regarding which mortgages best suit individual clients' situations. Understanding repayment periods and terms with private lenders. Repayment periods for commercial mortgages vary according to how much is borrowed. Typically, it's anywhere from 1 year to 10 years. Some loans have longer payment periods. In addition, some banks will lend up to 90% of the appraised value of the property. Other loans limit borrowing to 80%. Still, other loans cap monthly payments at $10,000 per month. When shopping around for a commercial mortgage, ask questions such as, how much do I qualify for? Can I get a fixed rate loan? The repayment terms should be flexible enough so you can afford them. You don't want your business to suffer if you're unable to meet your obligations. If you decide to take out a commercial mortgage, remember many different options for choosing a lender. Ask yourself what kind of service you'll need before making any decisions. Will you need someone to review all documents? Do you prefer online banking? Are you comfortable speaking with a live person over the phone? Establishing rehabilitation costs along with architectural plans. Rehabilitation costs vary depending upon the size and condition of the structure. Smaller buildings cost less per square foot to rehab than larger ones. Rehab costs increase dramatically if the building requires extensive structural changes. In some cases, banks will lend up to 80% of the market price of a piece of land. This amount varies widely among different markets. The acquisition cost of raw land is not included when calculating the maximum loan-to-value ratio. In addition, there's a limit on what percentage of the total project budget can be spent on acquiring land. Banks prefer to see at least 20% of the overall project budget go towards buying land. Closing costs include legal fees, title insurance, surveyor charges, appraisal fees, etc. Closing costs depend largely upon how long it takes to close the deal. A typical closing time frame ranges from 30 days to 60 days. Some borrowers use their own funds to purchase land. Others borrow against future income streams like rents collected during construction. When using private financing sources, expect to spend more upfront. But, you won't face additional costs later on down the road. Measuring actionable plans through private funding. Architectural plans should specify exactly where each room will be located. Each room should have its own electrical outlet, plumbing fixture, heating/cooling system, window, door, etc. All rooms should connect properly so that utilities don't run into one another. An actionable plan includes all these details. Having a backup plan and knowing how you would handle certain scenarios before it happens is essential. You never know what could happen during your time away from your business. It's important to think ahead and prepare yourself financially while you're still able to do so. The return on investment depends heavily upon whether you choose to rent space instead of selling it outright. If you sell the property immediately after completing renovations, then you lose most of the profit margin. On the other hand, renting allows you to keep 100% of the profits generated from the sale. Conclusion. Hard money lenders for business are great alternatives to the conventional type of lending methods. With them, you get access to capital without having to put anything up front. And, since government agencies don't back them, they offer much lower interest rates than regular mortgages. However, just because a hard money lender isn't regulated doesn't mean they provide subpar services. Many reputable companies work closely with local governments to ensure that projects meet code requirements. Fast cash can be obtained from hard money lenders. They are used to finance almost any type of business, including real estate, equipment, inventory, or anything else that you need cash for right now. Call 888-653-0124 today or click the link here to get started today.